You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
And now, it's time for the show that breaks down the options market, from unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the option block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike Tosaw from RCM Asset Management, Andrew the Rock Lobster Giovinazzi from OptionPit.com, and Mark the Greasy Meatball Sebastian from OptionPit.com. And now, get ready to hit the option block.
Good afternoon and welcome to the 30th anniversary of the crash edition of the Option Block. Typical voice of Mr. Mark Longo. He is out on assignment today at the FIA show. So I am your host today, Mike Tosaw, with my partner in, well, I'm not going to say crime because we are not criminals here by any means. And I am the host, so I get to call him whatever I want to. My good buddy, Mr. Mark Sebastian. Mark, how are you today?
I'm super happy. It's great to be here. It's a beautiful day here in Riverside. I'm guessing it's almost as beautiful up in your neck of the woods. And, it was there's nothing I love more than celebrating anniversary. And
for sure.
30 years ago.
For sure. And yeah, we were talking a little bit about the show in terms of how old we were and what was going on that day of the crash. I still remember 1987 and that day, just watching my parents being totally freaked out and me wondering what the heck was going on with all this, being the astute future business major fifth grader with which I was. And I think I was just like you, thinking about my Halloween costume, which I believe that year I think that was the first of many years in a row that I was Mike Singletary for Halloween.
Oh, that's a good costume. That's a great costume. I was... In 1987, I was a whopping 9 years old, so what does that make me? Third or fourth grade, I want to say. I believe I went as maybe a G.I. Joe guy, potentially a Transformer, maybe a Ninja. One of those three is the ones I was thinking. Now, actually, one thing this is my personal story. So the day of the crash, about half an hour, he talked to the girl interviewing him for about a half an hour, and gave her all sorts of information which she used, and then his only quote was, "It's a good thing that the windows on office buildings are hermetically sealed, otherwise people would have been jumping from them in droves." So that was the only quote that made the Wall Street Journal after he gave all this intelligent reason for why things happened the way they did. But, it's still a great quote these days, 30 years later, isn't it?
Oh, for sure. It's something else. And, the funny thing is just on that one day, the market dropping 22%. And everyone still talks about very frequently to this day for all the older people that were still there at the time or still in the markets at the time. But in reality, markets bounced back rather quickly from that. I remember that was a time when President Reagan, someone was asking him about that the next day, and I don't remember watching this as a fifth grader, but I've seen it many times, or I've seen this before, just me being the market history buff with which I am, and the direct quote from Ronald Reagan was, well, the market goes up, the market goes down. And that's all that was talked about.
That's a great quote. And the other thing is people think that this occurred in a absolutely isolated, and that's not true. The S&P had been down pretty hard on the Friday before, and I believe the Thursday before. This major sell-off followed the standard sell-off Thursday, worst sell-off Friday, crash Monday format that we've seen a few times over, the past 30 years. We've seen that. I believe the last time we saw that exact formation was in 2015 with the China debt, but I believe that was the almost the exact case that happened in 2011. I believe we saw something similar in 2008 at a certain periods of time. And yeah, because we came in and Lehman had gone out of business. So this is a standard format that we do see a lot. Actually, it may have been a Tuesday because we may have had MLK Day closed or something been closed for MLK or something like that. But yeah, no, this was not everyone talks about it like it was such a shock. And it was, because it was a major sell-off, but it was not it didn't occur in the vacuum that it gets laid out to be. There was writing on the wall. There was hints. There was things already wrong with the market when the crash of 87 happens. And that's the part that I think the major financial news organizations just kind of ignore. They talk about it all day today. Didn't talk about it Friday. They're not going to talk about it tomorrow. But it was really a 3 to 5 day event. And you're right. A month later, we were right back, as I recall.
Yeah, for sure. And, I'm going to use this anniversary opportunity to say what I try to say at least once a year on this show. One trader was selling puts. He was doing really well selling puts. And he kept making monthly income, and he kept saying, wow, I had a great year selling puts, except for when the market crashed. But who could have possibly predicted that? And then the response by the other trader was me, because I was buying those puts every time. And there were people buying puts the days before the big market crash, and there was likely a whole lot of grinning going on by put buyers that day. That's for sure.
Yeah, well, hopefully those put buyers took their money, because
yes.
The next 30 years did not go well for them.
They did not, for sure.
They got a little bit of their money back in 08, but not get inside. But they did not as a whole do consistently well after the fact. One of the major things that we do talk about as option traders relative to 1987 is people will argue that was where the concept of skew in options really began. And that prior to 1987, there was a little bit of a smile on the very edge of options, but a put that is, 5% out of the money had a lower value than a call that was 5% out of the money because of interest rates. And that is something that is no longer the case. Combination of interest rates and a combination of the fact that volatility for out-of-the-money puts is more expensive than volatility for out-of-the-money calls.
Oh, for sure. And that's one event that it changed the way that the game was played. No doubt about it. And I use that skew to this day, even with things that I do. It's not, by all means, it's not the basis of my business by any means, but that exact skew from that event is a very real part of how I do things even to this day. With that, let's fast forward 30 years and talk about the here and now. We got a lot going on today, Mark. What is lighting up the tape, as our host Mark Longo would say, in the option pitch?
Well, we had the market opened down as much as 0.5% today. The NASDAQ was down over 1% on the morning, and then they bought everything. And, the S&P was down 12. It ended up 0.84. The NASDAQ was down as much as 1%. It ended up down 0.5%. The Russell 2000 was down 1%, down 0.25% by the end of the day. The VIX cash was up over 11 for a little bit, and it looks like it's going to settle unchanged. So not exactly the fireworks that we initially saw this morning on the open by any means. Instead, what we saw was a 10-point sell-off get bought, having a dip buying experience. Now, there was some action in some individual names, though. The big driver of the NASDAQ 100 was Mike Tosaw's favorite stock. And then along with Mike Tosaw's favorite stock, there was some softness in Apple and Google and FANG and Facebook, the quote-unquote FANG names. Netflix was a little soft. So we saw some softness there. But that was kind of the extent that we saw kind of everything. Was that we really were a NASDAQ-driven sell-off, despite the fact that the headline said Europe, but that really wasn't what drove things. It wasn't Europe at all. It was almost entirely NASDAQ and the NASDAQ 100 and FANG.
Yeah, for sure. I think the FANG names were the ones that were the drivers of this sell-off today. And but in reality, the market as a whole, buyers came in. I mean, I believe we were down 12, 13 points in the S&P pre-market. And then we dipped a little bit for the first half hour of the day. And then once we got to that dip on the S&P, it was just buyers the rest of the day for sure. So with that, what's going on right now in the VIX futures these days? Are there anything that our listeners need to be aware of in terms of any contangos or anything like that? Or give us kind of a rundown of what you guys are seeing in VIX land these days.
Well, the curve has really flattened. It had been so steep. And interestingly, we did not get a big pop in the VIX futures with the big VIX move. There was something kind of settled. There was still a padding there, but VIX futures really did not react to the VIX. They acted pretty normal. The curve itself looks kind of flat. November, if anything, looks a little, kind of not expensive, and December in particular looks really, really, really cheap. Not as cheap as it was a couple weeks ago, but it does look really cheap. And so in terms of the VIX futures themselves, other stuff that we saw, I don't think we've chatted since IBM had their earnings and just blew the doors off. How about IBM? And then Netflix had great earnings and is now down $7 from where it was prior to the big move.
Oh, it's crazy. Yeah, I have a client that we've been doing the wheel trade on IBM for a while now, and we've been able to do the 150 level for a while. And so just going into the earnings announcement, IBM, I believe it was at like 146, 147. We're short the 150 calls for that expire tomorrow, and was expecting that it would at least hold its own or maybe stay around the 150 level, but looks like we will be in cash come this weekend and be looking to sell some puts to get back into that one again, which is obviously a good problem to have. But yeah, that one came out of nowhere, seeing IBM have around a 10% move in a day. That's crazy for something like Big Blue.
I was shocked at that move. I was shocked they had good earnings. Two, shocked that they moved that much, and then they've gotten follow through, up another 1% today. So some pretty strong stuff. Really everything, that was just a total shocker. Netflix, talk about, when we were on the show Monday, it was up $3. It ended up opening up down $2, still well below the straddle price. And then from there, it just consistently has fallen, 50 cents to $2 a day. Today, down another 40 cents. It's just been a kind of a rough go. Couple other names that had earnings the last few days: Goldman and Goldman, which is down a little bit from where it was, but it's looked strong. The other one that looks surprisingly strong, this was a little surprising to me, Mike. When we were down at the bottoms, Wells Fargo was green and then continued to stay green. It was up almost 0.75% today, 34 cents. And that was kind of some interesting, some really interesting movement. And maybe there's a bid coming underneath Wells Fargo. Some people saying, you know what, I'm going to get back in. It's Wells Fargo. It's going up. Why bother fighting it?
Yeah, maybe they figure the bad news is already out on them. It's time to start to buy on bad news.
I mean, it seems like you should buy bad news, buy good news, and sell maybe really good news. Does that sound right?
I don't understand what selling is. So
yeah.
You're gonna.
So, yeah, what happened? What was the deal with Apple? Why was Apple down 4% at one point today, Mike. And was that you doing all the selling?
No. I made one big Apple sale about 4 years ago, and that was done with a great big smile on my face, quite frankly. No, I think that with Apple, I think, the concern right now is with the iPhone 10, is that going to harm sales on the iPhone 8 just because it's so insanely expensive? Apple has their most important quarter of the year coming up with the holiday season. So I think it's a lot of nervousness right now overall with it, not necessarily today, but just in general with Apple. There is a lot of fear with it. And with Apple, I could see a pretty, I made my bold guarantee on the show on Monday that something is going to happen somehow by the end of the year, maybe. And so I'm going to add that guarantee to Apple that something is going to happen somehow, maybe, with Apple by the end of the year as well. I think that they are at either a tipping point or they are at a point to where they can go much higher. And I think this holiday season for Apple is going to be huge for whether it's good or bad. I think this is going to be these are a very important couple months for Apple right now.
Well, the analysts are now saying, well, the reason why the 8's disappointing is because of the X, and lots of people are buying the 7 or waiting for the X, and they're not paying up for the 8. What do you have to say to people that think that?
Well, I think that here's the hard part about Apple. There's always going to be the people that got to have it no matter what, that they'll pay $10,000 for the silly iPhone if they think it's really that good. You're always going to have people like that. But as Apple grows, eventually someone like me, I use technology every day. I stare at a computer screen all day, watch markets go up, go down. I talk to the computer screen, trying to tell the market to do. By the way, that doesn't work in case anyone tries that at home. But I'll continue to keep trying to do that. But my point is that I'm not, even though I use technology all the time, I'm by no means a technology geek. And people like me who are Apple people, as time goes by and the smartphone becomes more and more of a normal thing in society, and by more normal, I mean that not everyone does have them now, but as it becomes just even more of something that everyone uses, like for my dad, for example, he's 73 years old and he knows how to use the telephone part of it, which is good. But as more old people start to use it, as it's used more in schools, and by more, I think there's going to be a lot more use of them. But as that happens, people like me who don't need to have the super fast gigabytes and all that other stuff that I don't understand, quite frankly, I'm going to buy the older version of the phone. I know that there is another gentleman who I work with in my office. He got his Apple iPhone for free because of his phone plan, and it was like 3 iPhones before the one that's out there currently. I won't mention his name, but it does rhyme with Panama, kind of.
Oh, nice. Panama. Pavama? Yeah, no,
kind of.
Yeah, and I've got the iPhone SE. I don't need the ginormous screen. I don't need, if I wanted an iPad, I would get an iPad. That I want to use this primarily for making phone calls, sending text messages, and tweeting. I'm a big fan of the Twitter, and maybe a few other things here or there. I'm not using it as a de facto personal computing device.
Yeah, you're not streaming movies on the L train.
No, or the Metro or anything. I'm not streaming movies at all, except for on my screen at home. The reason why I bought a large television was to screen movies. The reason why I got a phone was to make phone calls, send text messages, and share funny picture memes with my group of friends. Those, I can share a picture of Kermit the Frog holding a glass of tea, looking relaxed, with some sort of relation, some sort of comment with just about anybody.
And that's the beauty of any iPhone. Even the first iPhone could still do that to this day. So, but anyhow, Yeah, that's kind of where I'm at with Apple. And speaking of Apple and unusual activity, which is really a horrible transition, but no one can quite do a transition like our man Mark Longo. So I know I'm dishonoring Mark with this transition. But with that, let's transition into the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
Welcome to the Odd Block, everybody. This is where we talk about stuff that's, well, quite odd. And if you've listened to us for the last 600 and some odd episodes, you'll know that this is where we look at unusual activity and see what is going on with things. So
we're going to talk some unusual activity right now.
Absolutely. We have a potential massive closing. Paper and NSC. Today, paper traded two size call verticals. Open interest on the strike seemed to lean towards closing. First one came in was the June 140-170 vertical. 17,500 June 18 170 calls trade at 90 cents. And we also have, it came up in two trades. The first one was 8,750 June 140 calls trading at $5.70. And then the second half came in at $5.60. And then, as if life could not get more interesting, came a much larger January vertical. 50,180 calls trade at 205, and at the same time, 50,000 January 150 calls trade at $6.80. Mark, make some sense of this, please. There is a lot of paper flowing in NSC.
Massive closing is actually what we call the rock lobster's hind end. I don't know if you knew that.
Good to know.
Yeah, as opposed to massive opening. That's what the people call my mouth. This looks like it was a trade that had been open, and they came in and just moved money around. Seems like they were just kind of closing the vertical and kind of closing everything else around it.
Yeah, I would.
And then, maybe they rolled it back to Jan, but this looks like definitely closing kind of across the board.
Yeah, I could see no other. Yeah, I wouldn't see any type of roll with that. I wouldn't see any type of hedge with that or anything along those lines. This does just look like.
It's moved. It's already well below those levels. So I think it's just a little bit of towel throwing, if you will. For sure.
The next one that we have on here, we have a review from August 17th.
Ooh.
Yes, on rolling winning puts in EPI. It's always fun to roll winning puts, I always say.
Mm-hmm.
Paper traded today, 7,500 AUG 26 puts for a nickel. That was followed with 12,500 SEP 26 puts, trading near the offer for prices ranging from 40 to 45 cents. Now, from here, it looks like paper is rolling a winning long put position from August to September, nearly doubling their size at the same time. Now, the guy missed on the timing because EPI sold off to around 25.40 shortly after expiration. What are your thoughts on this, Mr. Mark?
This was an interesting one. Looks like he was I had something similar happen. I had some long puts on Amazon. I sold at 66 cents, and this morning they would have been worth a lot more than 66 cents. So that is something that can happen. Even the pros that are slinging these size sometimes miss on the timing and move things around before they should have. Guys should have traded this as an October trade or a November trade instead of September.
Yeah, it's one of those things where now that we have our hindsight glasses on.
Yeah, but, maybe the guy's out of the stock already. Maybe he had some sort of reason that he had to hold the stock that long.
That's true. Yeah. You never know. And that's why it's fun to parse a lot of these things.
It is.
Speaking of parsing, I'm about to do some parsing here in a moment on the strategy block. So this will conclude the odd block. And now we are going to go right into the strategy block.
It's time to dispense options wit, wisdom, and education. It's time for the Strategy Block.
Welcome to the Strategy Block, everybody. This is the section of the show where, I talk about strategy. This is when I get the microphone, but today I had the microphone the whole time, so it's not quite as special today. I don't get near the introduction that Mark Longo typically gives me, but nonetheless, I'll introduce myself. Here I am. All right. Today on the Strategy Block, what I want to talk about is hedging a stock. Now, we just talked about a put roll a moment ago, and I want to talk to you about ways with which you can hedge a stock and make it a little bit more inexpensive, and just the concept of using a slightly more sophisticated means of hedging as opposed to just buying a put. Now, let's say, for example, that you believe, let's say XYZ stock has increased a little bit for you, and you're thinking, okay, I want to sell some calls on XYZ stock. I'd like to collect some income on it, and you know what? In case it does pull back a little bit, I want to have a little bit of protection on it. That's one way to do it. But here's the problem with doing that right now in this market environment. Most likely, XYZ stock does not have very large amounts of premium to sell on it. You likely will not be getting a very good income on doing that. Here's the second problem with doing it. I don't like it. And here's why I don't like covered calls as a hedge. A covered call as a hedge, it's a Band-Aid. Now, here's what I mean by a Band-Aid. Let's say that a stock goes from 50 down to 49. Well, I would view that as a paper cut. And for a paper cut, that is something that a Band-Aid would be a very appropriate medical treatment to it. So in that case, if the stock were to go from 50 to 49, hey, that covered call that you sold for 80 cents or whatever it is, hey, it's a great thing, and you're not feeling any pain from that. But here's the problem. What if the stock goes from, say, 50 down to 44? Well, that's kind of a severed jugular, is that you're going to lose more than 10% on something like that. And that's where there needs to be some concern or possibly some alternative ways with which to hedge. In today's environment, we actually have the ability to buy options at a relatively cheap price. Now, my opinion right now is that I think the VIX is at the lower end. Technically, the VIX could, in theory, be high right now, meaning the VIX is going to go down to 6 or 5 in the course of the next year. Thankfully, Sebastian has his mute button on because he's probably choking on his coffee right now, laughing so hard with what I just said.
That would be nuts. I would tell you. I will take the other side of anybody that wants to a VIX level below 9. So, Mike, I agree with you.
Okay, so my point is that in theory it could happen, but I'm just stating this for the purpose that I'm of the opinion that the VIX is at the lower end of its range right now. I think it could get below 9, but I don't see it going to 5 or 6. But anyway, my point is this, is that right now what I'm trying to do with a lot of my trades is take advantage of lower priced options. So one thing you could do is you could buy a put option on XYZ stock. It's increased, puts are relatively cheap. That's one way of doing it. But here's another way that a lot of people really don't see when doing a hedge on a stock. And it's not quite a full hedge. It's not a full cast by any means, like if you have a broken leg type of hedge, but it is a type of hedge to where it is greater than a Band-Aid. You could call it maybe stitches, let's say. Stitches and a really nice dressing. So with that being said, why not do a put spread? Here's why I think it could be beneficial in this environment if you're looking to hedge or at least have some type of protection on a stock that's already increased. Stock's up higher, and let's say XYZ is up at 50. Why not do maybe the 50-45 put spread for a few months? The benefit of that is that if it does go down $5 or $6, which is over 10%, then you have protection for that time frame. Now, yes, you'll have to pay a little bit of something for the put spread, but it won't be extremely expensive. The other benefit of it dates back to 1987, and that would be the skew factor that exists. Now, the skew may or may not exist on your stock, but as Mark talked about a little bit in the beginning of the show, and I talked about last week on the strategy block, which, by the way, if you didn't hear it, tune into the show a week ago. I thought it was one of my favorite strategy blocks anyway. The fact that put options that are out of the money cost more than call options that are a similar amount out of the money. Does it happen on every stock? No, and it is more typical in an index as opposed to an individual stock. But by looking for this, you can have higher volatility that you're selling on the put that you're selling at a lower price. And so by doing that, does that mean this is a free put spread? Good gosh, no. But this is a way with which you can have some protection, and the protection is limited, no doubt about it. But what this does do is this gives you a way to buy an option spread trade at a somewhat favorable price in this environment. You can take advantage of lower volatility because of the fact that the VIX is low, and you get a little bit of the skew in by selling a put against it as a way of hedging for the stock to go down, not to zero by any means, because if the stock goes to zero, then, you at least were able to save 10% of it, I guess. But if it's something to where you want a little bit more than a Band-Aid, and you're not necessarily looking for catastrophic downside protection, this is something to consider. And if this is something that if you have a stock that you're not concerned with it going out of business, and you are concerned with it possibly having a little bit of a pullback, but you're not looking to sell it yet, this is something to consider. And that is the strategy block for today.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
And we are out of the strategy block, and now we are into the section of the show that, it belongs to you, the listeners, and that is the Mail Block. So the first thing that we want to do is talk about earnings. Earnings is here. Which name do you plan to trade most actively in this earnings cycle? And so far, we have, of the four choices, we'll get, Mark, your choice, and then we'll say how the poll is going. We have Tesla, we have Amazon, we have Apple, and we have Alphabet, a.k.a. Google. What do you think the audience is picking, Mark? Don't cheat and look at your show notes. And what would you be picking, even if you ever were to trade earnings, which anyone who listens to this show knows that you don't do typically?
I would be still looking at, Tesla was winning on Monday. I'm going to guess it's still winning. And then I'm going to guess that I'm going to go with, Apple.
Wrong and wrong. Well, actually, You're not wrong because you know what you would pick, but Amazon has actually taken the lead. Amazon is winning. Yes, Amazon is in first place at 41%. Tesla is in second place at 31%. Third place is Apple at 17%. And then hauling up the rear is Alphabet. I have to tell you, I'm actually surprised that Amazon took the lead on that one myself.
I am too. I'm not surprised about Alphabet. Ever since Google split themselves into two pieces, the entire complex, the entire two stocks have been completely different. They've gotten so much more boring to actually trade. I don't know why, but it just feels that way. Like, do I want to trade the search, or do I want to trade all the other stuff? I liked it better when the two were together, and now it just doesn't really work that way anymore.
Yeah, I could see that. I could see that as well. So
disappointed.
Yeah.
But I'll tell you, I am surprised, but maybe it's because Amazon had that Herculean run back above 1,000 that people started to say, oh, you know what, I do want to trade Amazon. sometimes stocks make moves around earnings, and it changes the way we trade them, and that's probably what happened here.
I would agree. I think that's the case as well, for sure. So now with our newer poll, this is one to where you've made many comments on it before. So I'll ask you again, just because it's always good to hear your opinion.
Oh, thank you.
Do you think that options should be traded after hours like stock? It is earnings season. We seem to talk about this every earnings season. Yes, no, or don't care. What do you think the audience said? And tell us what your answer would be again.
Audience is yes, and my answer is don't care. I don't think it's, it's not like you wouldn't have any liquidity there in or around earnings. It would be, the audience thinks they would get more of a benefit than they would. I would point them to S&P 500 futures options, which do trade 23.5 hours a day or 23 hours a day, and just how little goes on there, even when the market is moving around. Look at the overnight volume in SPX and ES options. So SPX options trade from 1 in the morning on, and then look at the ES options, which trade all day. There was almost no volume yesterday, and yet all of the action, all of the price action that we saw, relative to like the opening hours, was way more interesting overnight. All the range was overnight. So, and yet we still didn't see anything. So I'm going to say that the audience definitely wants it, and I do not care. I think it adds zero value and would not trade it.
Got it. Yeah, the audience did say 71. Audience said 71% yes, 25% no, 4% don't care. For me personally, I would not have a need for it. I mean, I like shutting off my screen at 3 o'clock and then being done for the day. And by done for the day, I mean checking my phone every 10 minutes at night, driving my family nuts on the futures. But that's another story.
Well, right, and let's not forget doing podcasts.
Of course. But
yeah, no, I actually, Mike, I'm going to take us down a little rabbit hole here. So, how do you deal with? I do the same thing. Look at futures. But it's amazing. You can almost tell the VIX level by the number of times that I review what S&P 500 futures are doing overnight. Like if I'm looking a lot, VIX is rallying. If I'm looking almost never, VIX is not. And I started to realize that, especially with kind of the way the automated programs are working on the open, that what happens overnight is not really affecting that much, which kind of helped me. Although I was talking with Keith Harwood, who does a newsletter for us at Option Pit called the Breakout Bulletin, and he was telling me, like, last night he looked, and last night was the first time futures had done anything overnight in a while. And he started thinking, he looked at 3 in the morning and then started thinking about what he was going to do in the day and could not go back to sleep for 3 hours because he got his mind working. I mean, how do you deal with S&P 500 futures at night? What do you do?
Well, recently they don't move too much, so that one doesn't bother me recently. But last fall is a good example of it. Last fall was probably the most gap-driven rally, I think, of my entire career in this business, meaning that it seemed most of the market movement actually came from a gap up or a gap down from the night before. And so, oftentimes what I would do, there were a couple of nights to where my general routine, I probably look at the futures in reality after the market closes. I'm usually done working for the day, 4:30, 5 o'clock, something like that. And there's days that I coach football. I have football practice some days too. I'll probably look at it maybe 4 or 5 times after the time I leave my desk till the time I go to bed at night. And I've just kind of come to the conclusion to where I've accepted it, to where even if the market's not moving or getting the crap kicked out of it, I constantly plan for that with my trades themselves, to where even if we have a 1,000-point move in the election, let's say, when we had that election move, when the Dow was moving 1,000 points in the futures on election night, that's why you buy the hedges. Crazy. Yeah, and for sure. And so I've even thought of with the speculative stuff that I do, which is not doo-doo, by the way, the speculative stuff that I do.
To make a joke that you said doo-doo.
I know. That was funny, wasn't it? We have little kids. It's fun. So when I do that I've thought about going to the futures option side of it just because of the fact that I've been up at night saying, oh, man, if I was instead of an SPY or SPX or whatever, I could get out of this trade right now and I'd be in cash for the night. I would have already made my profit. But there are times to where I'm like, oh, I wouldn't have stayed in that if I would have been able to get out of that at night. And the next day, by the time of the open, the market moves enough my way to where it wouldn't have mattered. So overall, from what I've found of my unscientific study of that stuff, it's about 50-50. And so I'm not making short anything, and I'm not levered on anything. So even if we do have 1,000-point move against me, I'm okay for the most part, and that's taken me years to settle myself on in doing so. But I would say probably over the course of the last 3 or 4 years, and I think I've been in the business for close to 15 years now, it's probably taken me over 10 years to finally get over that, so to speak.
Yeah, as I recall, in my lifetime, all the stuff that I've done after hours, I would say 85% of it I wish I wouldn't have done. In that, things were better for me when the market woke up and there was and the bell rung and things had settled, or the things that were moving that I wanted to move kept moving. It was just very rarely was I happy that I'd done what I did overnight when I did. It was kind of a shocker.
No, I would agree on that.
That's the way.
Yeah, because you're not dealing with the real money of Wall Street at that time. It's like trading the last week of the year after Christmas when everyone's up in the Hamptons.
Right. Or like right before Labor Day, or the month of August is part of the reason why August is so volatile is because nobody's trading it. You're right. So like I said, I think, just circling back, I think that, yes, 71% of our audience wishes that we had after-hours options. And I'm going to guess that if they actually had that 60 to 71% of that 71% would end up regretting that they traded overnight once they got overnight options.
Yeah, I mean, the only time that I could see it being really useful to the retail trader is on earnings but here's the reality of how that typically works. If you were to look at like a Fed announcement, say, look at SPY options after a Fed announcement. Now, when the market's actually going to move, not when it's going to be, as Mark would call it, a resounding meh, but when the market actually moves 10 to 20 points in the S&P off of a Fed announcement, if you're trying to, and I've tried to do, I still try it now. I put out before and after Fed announcements. Sometimes I don't do it as often as I used to, but I'll put out like crazy limit orders to where if the Fed will go down 30 points or something like that, then I'll look to buy this certain call at a really cheap price in the hopes that it'll come back right away. But here's what's happened to me 100% of the time. It's still, I shouldn't say at one time it actually worked, and it worked pretty well, but it wasn't a big deal. But because I didn't have a lot of size on. But if you look at the option bid-ask spreads when there is that big Fed announcement, they're 9 miles wide, even on SPY. So that leads me to think that if we did have after-hours trading on an Apple or a Google or something like that, if you're hoping that, they just made a 8% move, I want to get out of my calls. And if that's the case, if you're trying to get out of your calls at that point, that because of the fact that it's crazy during a Fed announcement during the day, that makes me think that if it's after hours when there's no real money involved, not near as much real money involved, that kind of makes me think that it would be a wide bid-ask spread at that time as well.
Oh, for sure. Absolutely sure. There's no way it wouldn't be. It would be impossible to trade for a little bit. I mean, folks, take a look at how these things trade when how the stock itself trades around the announcement. It's super wide. So, that I would think that it's a huge waste to
spend a ton of time worrying about, after hours stuff.
Yeah, I mean, if I knew it would work and we could get the penny or nickel bid ask spreads, I think I'd be for it. But the fact that if we can't get it on a Fed announcement on SPY options, that makes me think that the fact that real money that's not trading at that time of day on individual name, that we would not get it. So
you would not. There's no way.
Yeah.
It would be a ginormous waste of time. It would be, you would just be, you'd be bored. You'd be looking there trying to do stuff and nothing would be happening. Similar. I'm trying to remember when we had that whole China thing a few years back, and we gapped down 50 points. I'm trading SPX options, super liquid, and I can't get anything done. There's zero market because we're in what's called a fast market, and you'd be dealing with a fast market situation in those scenarios, and that's just part of it.
Got it. All right. Well, with that, let's go and do some of these questions from our listeners. And we actually have a lot of them today, but we're not going to get to all of them. But we will get to a couple of them. First one is this is from Darqane. Assigned on short SPX puts means getting long the underlying. But how does that work if it's cash settled? Mark, can you shed some light on that for us?
You can't. Well, one, you can't be assigned. You can only be put to, and then you're put to cash. So the way that the SPX works is, all right. So let's say I sell the 25.50 puts, and SPX settles 24.40. All right. So those puts are $10 in the money. The way cash settlement works is I have to have $1,000 debited from my account for a one-lot option to pay the opposing party that bought those puts the $10 that were in the money. So it's actually a change of hands in cash, not a change in hands of stock. And there's no early exercise because SPX options are European. So it's literally the amount of dollars at expiration that you're either in the money or out of the money that exchanges hands.
I think that sums it up from a man who trades quite a few SPX options.
Indeed.
For sure. All right, so here's another one. What option trading strategy would you say is best suited to people with absolutely zero knowledge of options? And that is from Butcher Boys. And I'll tell you what I would recommend with that. Go to optionpit.com and buy something there. That's my strategy.
Or my strategy would be go find a good financial advisor that understands options and have him work with you while you're working with me learning options so that you have the benefit of a wealth manager that is managing your dollars in the best way possible and the advantage of learning what that person is doing so that at a minimum you can become a better client, and at a max maybe you learn a couple things and put some trades in on your own.
It is. And the benefit of this day and age, there is a lot of free stuff out there from the exchanges, but also if you go to some place like the Option Pit, back when I first started trading back in the early 2000s, if you wanted to have any type of options education, there still was some stuff from the exchanges, but the websites were not near as robust at the time. And there was some free stuff out there, but not a lot. But for the most part, what you had to do was spend thousands and thousands and thousands of dollars to go to a seminar, and half the time at the seminar, you were going to be pitched on another seminar.
Right.
Now, in this day and age, you can go to the Option Pit, and there's just all sorts of education out there, very reasonably priced one-on-one mentoring. Obviously, nothing's free, but with the bang for your buck of what you actually get today, as opposed to back in the days when Wade Cook, the cab driver, was the only game in town, it's really come a long way. And so the information age that's out there, the information that's out there right now, it's really good. And there's really no excuse to start just picking away at things thinking, oh, I'll buy 10 out of the money calls for a nickel as opposed to this one in the money call. And the stock moves 4%. How come I didn't make money? Options suck. I'm never trading again. There's no reason for that in this day and age.
I could not agree more. You hit the nail on the head there, Mike. But the one thing I would comment is the most major firms, most brokers, and don't take offense to this, Mike, most brokers are more interested in sales and being lazy and putting together what sells than actually doing what's best for their client. They don't want to do what's bad for their client. They want within their scope of capabilities to do the best job they can for their client. However, from their end, a risk management standpoint, or whatever, adding options in adds a risk component that a lot of them just don't want to take, and so they don't. And so you, as the client, don't get that benefit, and you as the client end up in far worse shape. And that is probably my number one issue with the balance of the brokerage industry, the kind of a financial advisor, is there is a level of become an expert at sales and a mediocre financial person, as opposed to become an expert financial person and a good sales guy. If financial advisors spent half the amount of time educating themselves that they do taking sales seminars, I would tell you the American people would be a trillion plus richer.
No, I would.
That's why I like that, which is why I like you, Mike, because you take the time to educate yourself. And you
I
push.
appreciate that.
And I think that's something.
No, I appreciate that. And it's one where you're right on that, because every broker out there, if it's a commission-based broker, they don't make money if you don't trade. And so there's always not to say that all commission-based brokers are bad by any means, but
no, they're not.
You always have to look at the fine line of what's ethical and what makes the most sense and how you do things. And yeah, I think that's the truth. So with that, let's do one more question.
Now that I threw a lot of brokers under the bus.
For sure. But we've thrown brokers like that and analysts under the bus all the time on this show.
Yes, we enjoy doing that.
Yeah,
they deserve
that's why
it.
We tell the truth on this show. So final truthful question for someone who has probably looked at open interest at least 6,000 times in his life, may or may not use it. Why does open interest only update once a day? And I'm going to follow up with that one for you. Do you really look at open interest that much? And if you do, tell us a little bit about Sebastian on open interest.
I don't really pay attention to it too much, other than kind of trying to figure out what somebody is doing, like we do in the odd block. It's not something that's going to affect where I make my strike decisions. There are a lot of people that think it should. I've never understood that as an approach. If you're offering a decent price, people want to trade it. That's the way it works. Nobody cares whether they're opening or closing. But the reason why it only opens up once a day is because the market makers flow in and out as they trade can change so drastically throughout the day, and order flow in of itself can change so drastically throughout the day that it's very difficult to really keep a constant track on what the open interest is per strike. That's why we'll post volume. Volume gives us a very good look at, what is going on in terms of open interest, but it does not give us like the final. And, that's kind of the best way to do it, because there's be very difficult to keep kind of a real track of who's holding what and where. In addition, the clearing firms don't really report everything till the end of the day to the exchanges, which is the other issue. You don't just need the exchanges involved. You need the clearing firms that are actually clearing these trades to be able to make these things happen, to be able to make it real time, and that just will never happen.
No, I could not see that happening either. I mean, for me, in open interest, the only time I'd ever really look at is if I have a client that wants to make a trade in some stock I've never heard of, and
Yes.
I want to do a butterfly and combo this, and this stock, and I look at it, I'm like, oh, open interest of about 4, and I'll say,
Right.
let's not do that. So that's probably about the only time that I really look at either. So
yeah, I would agree. That is the only time. That is a time where open interest would actually be very valuable, because, figuring out that a stock doesn't trade is maybe the best value of open interest.
Yeah. Sometimes I would trade thinly traded stuff, but on MOO, ticker symbol for that, I think for 4 or 5.
You love that one.
Oh, yeah, and that's one, but I accepted the fact that I sell the put, I let expire worthless, and it's just a straight non-movable wheel trade, and I'm not doing any adjustments on this. If we get in, we get in. I haven't traded in a year or two, but for about 4 years or so, I sold a lot of puts on that thing, and so. But that was one. It was awful open interest. No way you're going to adjust it, and that would be an example of. You'd see the open interest on it. It was likely a majority of me and my clients on it most of the time, but that was cool. But anyway, that concludes this section of our show for the day. So with that, let's go to Around the Block.
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
Okay, Mark, it is Around the Block time. I've been watching SPY this entire show, hoping I could say my trademark saying, but we're still a couple pennies away from all-time highs in SPY, unfortunately. But with that being said, what's going on with you? What are you watching over the weekend and into next week?
Earnings. And like I said, I think they're going to pick a Fed chair here in the next couple of weeks. That could be fascinating.
Yeah, I would agree. And, for me, it's just generally the macro stuff. Waiting to see if something happens, and if we get another leg to the upside, this is going to shape out to be a really nice year for the bulls, such as myself, in the S&P. So I'm hoping we go up more, but as usual, I am constantly paranoid with my finger on the sell button as we speak, just in case. So
I like it.
With that, what is happening over at the option pit these days?
We should have it posted in the next day or two. We're going to have an easy VIX course coming up. And then on Tuesday, Andrew's doing a credit and debit spread webinar. So be on the lookout for that as well. So check your emails and check the blog for info.
Got it. And then in the RCM world, we actually are doing, it's coming up in November. We'll have a landing page for you soon, but we're actually doing a webinar with myself and our futures department. We're going to do kind of a compare and contrast with equity options versus futures options. Not partial to any one of them, but kind of the best of both worlds type of thing in case you're thinking of delving into the world of futures options. So We'll have more information on that in the coming weeks. So with that, I would like to thank my partner in educating the masses, not my partner in crime because we're not criminals, Mark Sebastian, for joining me today. And everyone, have a wonderful weekend. See you on Monday.
See you guys. Goodbye.
preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.